I would probably do them in an LLC. I would try to stay away from a government loan because, and here's why, guys. Let's think about the government. The government came in and basically just told you that if you have a government loan that you can't collect rent, I don't want to deal with that, man. And Fannie and Freddie, those are government. And so I'll still do them, but I don't want my whole portfolio being obligated to the government and telling me I can't collect rent if something happens, man. So what I would do if I was in your situation is I would just go do a buyout from your brother and sister. I would put a big purchase price on it, maybe more than what you guys agreed on. Go to the bank and then take your equity and roll the 20% down. And that way you may be able to just do one transaction, not have double closing costs. Let me know when you got some availability, man. We'll come hang out at the mansion. We'll have these cigar socials. You ain't got to smoke cigars, man.
Is this a mansion now?
This is a mansion, yeah. You know, I'm still in Kenny Rush's word, man. Kenny Rush be like, you come hang out at my mansion. Man, listen, man, I don't think it will. And here's why, guys. Everybody's calling for the market to crash. Here's why I don't think it's going to crash. Because we had 81 million millennials that need property. We got 78 million baby boomers that aren't letting go of their property. We have 40-something million Gen X, which is me. And then you have another group coming up that needs property too. And the cost to build property is way higher than existing inventory. So how is existing inventory going to crash? Let's look at what the government's going to do. What is the government likely to do right now? The government is likely to let inflation run away. Because if the government lets inflation run away, then that means that they can pay off the deficit with those worthless dollars they're printing. And let me tell you why I say that, guys. I'm going to tell you guys why. If the government can create 6% inflation a year for 4 years in a row, 6 times 4 compounded on each other is like 27%, right? They just inflated away 27% of the money. Now they got to pay that money back, so they create 6% inflation. They borrow the money at 1%. They're inflating their way out of debt, man. And I know what you guys are saying. Oh, wow, why would they do that? Well, they did it in 1940. They did it in the late 70s, early 80s. That's a cycle. That's what they do. What happens at the end of that cycle? We start realizing massive inflation. What happens after you realize massive inflation? You have to raise interest rates. I'm not talking about the 4, 5, 6, 7, 8%. I'm talking about up there. The government is likely to create inflation, right? And you can fight against the government and say this and that. Look, I don't care about none of that. Whatever they're doing, I'm just going to try to figure out a way to be advantageous for me, my investors, my employees, tenants, everybody involved, everybody around me, for you guys. That's it. I'm not worried about what they're doing. I know Como's getting impeached or whatever. I don't care about none of that, man. All right, well, tell them, look at it, man. That's 1985, man. You know, interest rates were 18%. Right now, we're spoiled. They're 2, 3%. Buy a property, lock in long-term debt. Okay, so why are they building new buildings? Is it overbuilt? What is your saturation in the market? That's all things that we teach you in the course. In other words, if you're running if your area is a 99%, here's what you want to do. How much is your rent in the area? Is your rent continuing to increase? Is your occupancy continuing to increase? In other words, let's say you were at 96% occupancy in your area. A new big building came online and they were charging $1.20 a square foot for a 1,000 square foot unit. But now the new building wants $1,800. So now that's $1,800 for a 1,000 square foot unit, right? Let's say they got that. $1.80 a square foot and the occupancy actually went up. You're in good shape. Let's say that it got absorbed and that the occupancy started falling. And then what happened was everybody came in and started dropping their prices a little bit to try to tick back up occupancy. But no matter what they did, the occupancy didn't tick back up. It kept falling. That means you're overbuilt. That means that you're in hyper supply. So you need to know how to read the charts and see if you're in hyper supply. What's driving your market? Are there likely to be more jobs coming in? Are the jobs that you have in your market? Let's say it's a newspaper company. Newspapers are probably going out of business. I wouldn't want to invest heavily around a place that made newspapers. I'd be wanting to sell that off unless we had some new jobs coming in. Complicated question, complicated answer, but you really have to study more and know more. And that's why we came out with this course, man, because I want you guys to know how to underwrite and look at this stuff.